A 7% yield, monthly payouts and a massive 30% return that has outperformed even the S&P recently. Today, we're stripping back the layers of EUSD to see if this is a gold mine or a classic yield trap. Welcome back everyone, I'm the Swedish dividend investor. I hope I figured out the settings on my new mic. So, as the title suggests, today we will take a look at Global X European SuperDividend ETF, ticker EUSD or EVSD, a European ETF with some high yield and monthly payouts, without covered calls. We will go through the following: what the ETF is all about, holdings, sectors and country allocation, performance, the small amount of data we have so far, dividend history, and finally, we will do a valuation. As always, this is not financial advice. I'm just sharing my own investment journey, my experiences and my analysis. Read the full disclaimer in the description. So the Global X European SuperDividend ETF seeks to track the sole active European SuperDividend Index. The index tracks European stocks with high dividend yields. The ETF replicates the performance of the underlying index by full replication. The dividends in the ETF are distributed to the investors on a monthly basis. Before diving a bit deeper into what that means, here are some quick stats. The fund size is 48 million euros. Their total expense ratio is 0.45% and the ETF is domiciled in Ireland. Reading their product profile, we see the following. EUSD focuses on European companies with sustainable high dividend yields, aims to ensure liquidity and stability by looking to select companies with a minimum market cap of $500 million and trading activity of at least $2.5 million over the last 1 to 6 months. Sector and country agnostic, limiting sector and geographical concentration. Individual weights are capped at 5%. Constituents must have a dividend yield of at least 4% and less than 20% to be added. EUSD includes up to 25 constituents, reviewed on a semi-annual basis and rebalanced on an annual basis to maintain alignment with dividend and liquidity criteria. We can also read the SuperDividend approach. EUSD looks to access the highest tier of dividend payers, potentially resulting in yields that have historically exceeded broader high dividend strategies. And they explain how the process looks. They rank stocks by yield and the top ones are selected for inclusion in the index. Stocks are then weighted accordingly to their dividend yield and they screen for dividend stability. The estimated dividend per share for the next 12 months must be at least 75% of the dividend paid over the previous 12 months. So, the ETF doesn't use equal weight like the big brother with a global focus, and the index and ETF is capped at 25 holdings maximum. That's a very high concentration. It is a bit confusing because they also write they rebalance the portfolio semi-annually at the last business day of February and August, but as we saw before, they also write they rebalance on an annual basis. So, which one is it? Alright, let's take a closer look at the holdings. In their top 10, we have Ithaca Energy, Vårenergi, MPC Container Ships, Aker BP, Banca Monte DEI Pasci Siena, WPP, Wallenius Wilhelmsen, DNO, Harbour Energy, and Van Lanschot Kempen. I hope I didn't butcher too many names here. Scrolling down, we can see some other companies. Not only energy, but a lot of financials, and even a Swedish gambling company, Betsson AB. What about their sector allocation? Energy at a massive 35%, financials at 31%, industrials, consumer discretionary, communication services, and information technology, so a heavy tilt into energy and financials. For their country allocation, we see UK, Norway, France, Italy, Netherlands, Sweden, Poland and Finland. Again, very concentrated since they hold so few companies. Checking their performance and total return on the max timeframe, that is since the 3rd of September 2025, they have delivered a 30% return. That's pretty good, but I would say not enough data and the massive run-up in oil prices surely added much to that gain. When we exclude the dividends, the price return is about 25%. But how does it stack up against its bigger brother SDIV, S&P 500, and a favorite, VDIV? Since we don't have much data, it will be the max time frame again, and it is since the 3rd of September 2025. European SuperDividend at 32.04%, VDIV at 19.83%, SDIV at 17.08%, and S&P 500 lagging behind with 14.20%. Now, I would say if you got into EUSD early, congratulations. I think this is not something to count on. So let's quickly look at their short dividend history. I'm a small creator on YouTube. Hitting the like, commenting and subscribing is a great way to support the channel. Thanks. So we don't have much to go on with this one, since they paid their first dividend in September 2025. And we can see their first 4 payments amounted to 0.46 euros, and their current 5 payments in 2026 amounted to 0.564 euros. Since they haven't paid 12 times yet, I simply added all the distributions up, divided them by 9, that's the payments, and multiplied it by 12 to get a sort of guesstimated 12-month distribution projection. That's 1.365 euros. At today's price of roughly 19.06 euros, we get a dividend yield of 7.16%. I made one single projection for the distribution, 1% compound annual growth rate for 10 years. We would have a 7.99% yield on cost if we bought today and pocketed every distribution. That's a big if. The SuperDividend ETFs does not have a good track record. Alright, with the dividend overview done, let's do a valuation. Why do we do a valuation? So we don't overpay for an investment. We want to be able to somewhat guesstimate what kind of return we could get over a 10-year period. We use a growth rate to project the dividend growth 10 years forward, a terminal multiple. This is what kind of yield investors give the investment 10 years forward. A high multiple means a low yield, so a higher price, and vice versa. We also use a discount rate. This is our required return, and it is used to discount the sum value back to today, and we get a present value. The present value is what we would need to pay to meet our required return. If the asset is trading above the present value, it is overvalued, and the other way around. We use 3 scenarios: normal, best and worst case. Finally, we will do a mixed valuation to get a fair price between all the scenarios. I've gone with a discount rate of 10% for all cases, and I've treated this one exactly as its brother. So, for the normal case, I've gone with 0 growth for 10 years and a terminal multiple of 12. So that's an 8.33% yield 10 years out. We land at a present value of 14.71 euros. For the best case, 0 growth but a terminal multiple of 14, so a yield of 7.14% 10 years out. That's basically where we are today. We land at a present value of 15.76 euros. For the worst case, I've gone with a negative 2% growth for 10 years and a terminal multiple of 10, so a 10% yield 10 years out. We land at a present value of 12.03 euros. For the mixed valuation, I've gone with a probability of 60% for normal case and 20 each for the best and worst case, landing us at a fair price of 14.38 euros or 12.94 euros with a 10% margin of safety. Ouch. I've gone ahead and added a ratio tab for a visualization of the valuation. We can see their current price is 19.06 euros and we got all the case prices listed. If the ratio is above 1, the cell turns red, and if it's under 1, it turns green. Red is overvaluation and green is undervaluation. The greater the difference from 1, the more under or overvalued it is. Going by percentages, it is 21 to 47% overvalued with the current assumptions. Changing the best case with a 7.19% yield 10 years out to a growth of 3% per year. Highly unlikely if you ask me. We can see we reach its fair or intrinsic value, changing the growth back to 0 and changing the discount rate to 7%. We can see the same thing, meaning if you bought today, it would either need to grow its dividend with 3% per year and be valued at a 7.19% yield 10 years out for a 10% annual return, or valued at 7.19% yield 10 years out with no growth, but then your annual return could be around 7%. With a lower multiple, even less. So it all comes down to overvaluation with this one. So what's my conclusion? You guys probably know I love high yield, but not at any cost. This one is overvalued. If the oil price comes down and the price drops to around 14 euros, giving us around a 10% yield, then yes, it could be a great buy. But I see the risk is to the downside. It is very concentrated into a maximum of 25 stocks, meaning a higher risk for dividend cuts. If they held 100 companies like its bigger brother, it would be more diversified. I would say, even with a higher yield, it is still very risky. But we don't have the dual currency issue its brother has, with the price and dividends being in euros. Good for European investors. And as always, dollar cost average is usually fine, but right now it's better to go with something like ASWN, PFFI, for an even higher yield and price stability. So I'm staying away for now, watching it and maybe have it as a very small position if they drop in price massively. What do you guys think about this one? Is it too risky, too concentrated? Do you hold it? Let me know in the comments. Thanks for watching, and I will see you guys in the next one. Until then, stay smart, stay patient, and keep stacking those dividends. Ha det gött!